Okay, welcome back. Welcome to video number 14. We're going to concentrate here in this video on confirmation indicators. Now, confirmation indicators are what they say they are. We use them as professional traders to either confirm or deny what we were thinking previously 6 to 12 months before they come out. Because 6 to 12 months before, we're looking at the leading indicators and trying to predict the future as traders and using the market at that point in time as a proxy for our views. So we either buy or short, or in our portfolio have a market neutral exposure at that point in time, and then at some point in the future, 6, 12 months down the line, we have what we call confirmation indicators. And these confirmation indicators are made up by coincident and lagging indicators. Coincident indicators are telling us what's happening in the economy as a whole at this moment in time, as in right now, in the present, or for example, around the present, so maybe in the last 3 or 4 weeks. Now, the one I want you to focus on the most here is the employment situation report, because the employment situation report contains the non-farm payroll number, as in the amount of jobs added in the last 4 weeks in the United States. And this serves as a classic example. The non-farm payroll number is a coincident indicator. It tells us what's happening now in the US economy to jobs. And it serves as a really good example because amateur and retail traders base their trading decisions on a very short-term basis on the non-farm payroll number. And this misses the whole point, because and for amateur and retail traders, this is the biggest mistake, because they're using an indicator which is telling them what's happening now, where the professional trading community has been told for months before that this is going to be the situation in the non-farm payroll number and in the employment situation in the United States, as in, if the health of the US economy is set to improve, then clearly 6 to 12 months down the line, there's going to be more jobs added. And if it's going to deteriorate, clearly 6 to 12 months down the line, there's going to be a net negative effect on jobs in the United States. And by the time the non-farm payroll number comes out, all professional traders really know that the situation is either going to improve or deteriorate. And economists base their estimates in non-farm payrolls on the leading indicators from 6, 12 months before, but also on initial and continuing claims in the 4 weeks leading up to the non-farm payroll number. So what actually happens is, by the time the non-farm payroll number comes out, all that's happening is the amateur and the retail traders who always lose money are the guys who are offering the liquidity on the other side for professional traders to trade out of their positions, because they've predicted this previously. Now, concentrate on the non-farm payroll. It's a confirmation indicator. As a professional trader, it confirms or denies your views that you hold already. So for example, if you think the world is in really good shape and you believe from the leading indicators that that US GDP is going to expand, you will be thinking that the non-farm payroll number is always going to increase and potentially beat. Now, what happens if it doesn't? Well, that denies that your view was correct. So you may have to change your view, but very rarely does this happen. So let's go over to the presentation. Make sure you see confirmation indicators for what they are. Again, try not to listen to the noise in the market, because every day, every week, every month, you're going to be told by the populist media that this number's really important, you should be focusing on this. A lot of it is just irrelevant. And what we've looked at so far with the leading indicators is the 3% of information that is really relevant and is going to make you money. And what you've got to do is take that, interpret it, and turn it into real dollars. But along the way, you should be diligent, not lazy. Be diligent to actually look at the confirmation indicators and make sure that your views are either correct, or if they're wrong, do something about it. Okay, so let's go over to the presentation and I'll see you on the other side. Okay, let's go through confirmation indicators. So indicators that come out each month that confirm or deny our views. So the first one we'll look at is the employment situation report. That's where we get non-farm payrolls and the unemployment rate. Second one we'll look at is US durable goods and shipments. Third, industrial production. They're all coincident indicators. They tell you what's happening in the economy now. So what's in the employment situation report? What's non-farm payrolls? Anybody know what non-farm payrolls are? It's the number of jobs added in the US economy in the last month, essentially. Everyone focuses on really the two main numbers, the unemployment rate and total non-farm payrolls. That's where you get it there. It comes out. How often does the non-farm payrolls number come out? Anybody know? Comes out every month in the employment situation report. And it tells you what happened in the previous month in terms of how many jobs were added in the United States. But there's something that we see every single week that is another coincident indicator, which actually tells us what's going to be in the non-farm payrolls. Anybody know what it is? Initial and continuing claims, jobless claims. You heard of that one? That's a weekly number for the previous week. What is that actually telling you? It's telling you how many people are added in the last week who claim unemployment insurance benefit. So you add up the 4 weeks and it should give you a good idea of what the non-farm payroll number is going to be. And what happens? All the economists that predict the non-farm payrolls number, they don't change their estimates because they're lazy. But all the traders know roughly what it's going to be. So by the time it comes out, even if it beats or misses, the number's old. It's already pretty much priced into the market. Not just for that reason, but because you would have known this anyway 6 months previously, or 12 months previously in the leading indicators. So what do all day traders do? Day traders focus on the non-farm payrolls number, and if it misses big or beats big, they're trying to buy or sell the market on that day. They're all late to the party. They've missed all the big opportunity because they've missed the leading indicators 12 months before, 6 months before. And they haven't been watching the initial and continuing jobless claims and figuring out that 150,000 jobs added in the last month in the US economy was consensus by the economists, but the economists' consensus estimates are old and they haven't updated them. And then the numbers reported as 200,000, and it doesn't matter because continuing claims and initial claims were going down for the last 4 weeks, which means it was going to beat. So we all know it's going to beat. So we used to have a fantastic saying at Goldman on the non-farm payrolls: the first move is the wrong move. So whatever the move is for the first 5 minutes in the market after the non-farm payrolls, it's the first move is the wrong move. So everybody's reacting to it, but they're late. So you take the other side. Provides you with liquidity to get out. Make sense? That's total non-farm payrolls with a long-term trend. Change in non-farm payrolls. So that's the number we look at each month. So you got on the left-hand side there, 50,000, 100,000, 150,000. How many jobs are added or taken away from the US economy? Pretty simple number. How do you look at it? Well, long-term trend of the US market, long-term growth trend, 3%. How many jobs? 3% GDP growth. How many jobs does the US economy have to add each month to run at 3% GDP growth? Well, historically, it has to be over at least 250,000, if not over 300,000. So we get a picture of what's happened in the last few years immediately. Without looking at it, if we know that, then if the US economy is growing at between 1% and 2%, jobs are being added, but a lot less than long-term trend. So what have we been getting? We've been getting jobs added of between 75,000 and 150,000 typically over the last 3 years. So the unemployment rate has been coming down, but it's been coming down very, very slowly. Total private employment, change in private employment. And you can see by looking at that chart and the change in total non-farm payrolls that since the 50s, in business cycles, in the part of the business cycle when the economy is expanding, over a number of decades, less jobs have been added. So much on longer term, on a big picture trend, there could be structural issues in the US labor market. And that tells you the story there in the private sector of the United States. So for example, let's take, so this is from the early 90s. So in the 90s, when the US economy was growing at an average trend of 3%, what was happening? 250 to 400,000 jobs added per month. In the noughties, 150 to 300,000 jobs added per month. Now, around 100 to 150. That's pretty much what we've been getting. So over the very long term, in the last 3 business cycles, what's occurred relative to each other is that less jobs are created in the US economy each business cycle that we go through. What you're looking at there is a picture of regulation, because if you regulate labor markets, that's what happens. We're talking stuff like minimum wage, yeah? That's what happens when you regulate labor markets. That's government employment. That's the unemployment rate. So private sector is the most important. What's happening in the US government with the US government now? What about jobs added in the US government level? Do we expect there's going to be lots of new jobs created in the public sector in the US? There's lots of cuts. So what you're seeing at the moment is the private sector paying for the public sector to exist. So you might get 300,000 jobs added in the private sector, but you'll get 100 taken away in the government sector. So total non-farm payrolls is 200. That's the trend at the moment. That's what's happening everywhere. So the employment situation report gives you a snapshot and really confirms or denies what you were thinking 6 to 12 months previously. You know, if you're expecting GDP to grow, you're expecting non-farm payrolls to be positive, and you can kind of guess what rate it's going to be at. You know, give or take 50, 100,000, yeah? So you're trying to predict what's going to happen in the future. And what you'll see in the ISM manufacturing report, in the non-manufacturing report, you'll see the businesses reporting that they're going to start employing people, because you've got to the employment area of each report. Are you planning to hire more people? And if it's above 50 for 12 months in a row, the non-farm payrolls number is going to be positive and going to be up. And then it confirms or denies what you've already been told by the leading indicators. Initial and continuing claims. So when someone in the US is made unemployed, what happens? They claim on their unemployment insurance. That statistic gets reported to the Labour Bureau Statistics, and they report it every week for the previous week. So by the time the non-farm payrolls number comes out for the private sector or the government sector or both, it's pretty much known from weekly jobless claims. They're out every Thursday. That's initial claims, 2000 to present. That's with a long-term trend in continuing claims. So what does that tell you? Continuing claims, what's the definition? It's basically long-term unemployment. What's the trend? What's the trend since the 60s? Yeah. Long-term, but it's an absolute number. Don't forget the population's increased. So it'd be better to put a percentage on it, but it's still trending up as a percentage as well. Tells you that long-term structural unemployment in the US is on a long-term uptrend. So you'll get this as well. You'll get the ESR and jobless claims in spreadsheets. What's the ESR useful for? Confirming or denying the leading indicator data, confirming or denying weekly jobless claims data, gauging the future pulse of consumers and politicians, because jobs are a politically sensitive issue. So if all the leading indicators are doing well and the government's not doing anything, but the unemployment rate isn't coming down, you can guess that there's going to be heat coming on the US government to do something about the unemployment rate coming down. They're going to have to do something. And consumers, what you're looking at there is the propensity to spend money as well. So consumer sentiment will be positive the more jobs that are added to the US economy. People will feel good about their future prospects. Confirming or denying your view on US GDP, and therefore confirming or denying a worldview. Durable goods and shipments, coincidence indicator. 85 industries in one sample, but they are big multinational companies with big capital-intensive products. It's the inputs of capital within the manufacturing industry. So when companies are making significant investments in big ticket items, as in they're going to create a new factory, they're going to demand big, bulky, heavy machinery, etc., the durable goods orders report and the shipments of those goods tell you what's happened in the last month in those industries, if people are making highly capital-intensive investments, yeah? If the businesses themselves are doing it. That should follow the ISM. So that's it there, in the green. And what you usually get is total new orders, and then they strip out sectors which are extremely sensitive to making the report non-accurate. So if there's, sometimes you get in the transport sector and in the defense sector, one or two massive orders that could skew the number. So they do it with a stripped out number as well for transport and defense. So for example, in the aerospace industry in the last month, what do you think has happened? What do you think has happened in the last month in the US aerospace industry? What are they cutting at government level at the moment? Defense spending. So just one cut in defense spending can have a massive impact on this number. So they strip it out, and they strip out transport as well, just so you can see the number. So what you'll see in company, I mean, you'll see the reports of companies like, for example, you know, with defense included, the impact that one order at Boeing might have on the durable goods and shipments orders, yeah? And then you can strip out Boeing's order of 20 planes, and then you get a better representation of everything in the US economy, yeah? That's what they do, basically. But you'll get the spreadsheet, go through it, go on the internet, Google it, it's all public information, learn about the durable goods report. It's there to confirm or deny what you've seen 12 months previously in the manufacturing data, in the leading indicators, yeah? So confirming or denying PMI data, confirming or denying US GDP, confirming or denying your worldview. Industrial production, another coincident indicator, gets reported with capacity utilization, and it's showing changes month on month, year on year in the business cycle, but what's happening right now. So it follows the ISM. That's what it looks like at an aggregate level. And that's what it looks like with all its components. So it can actually give you a good idea of what's happening in various industries. For example, mining, materials, business equipment, consumer goods. It tells you what's going on right now. You'll get the spreadsheet, check it out, go through the history, learn it yourself, go on Google, play around with the data, have a look at the report, have a look at multiple reports on the internet. It's all publicly available. It's how you treat the information that's as important. So it confirms or denies. Confirming or denying PMI data, confirming or denying your view on US GDP, and your worldview.
Okay, welcome back. What you saw there being presented was the confirmation indicators in the United States. They are the main ones that you'll see reported every month. So let's do a quick summary. What we saw was the employment situation report, which includes the non-farm payrolls number and the unemployment rate. We also looked at weekly initial and continuing jobless claims. So these come out on a weekly basis and you should be on top of them. We also saw the durable goods number, and the durable goods number is really tracking the big ticket items in the United States. That's a coincidence indicator as well. And we also saw industrial production. Now the way you look at all these, again, they're confirmation indicators and you need to see them for what they are. They are all coincidence indicators in that they tell us what's happening in the economy overall at this moment in time. So running through them, employment situation report, non-farm payrolls included with the unemployment rate and initial and continuing claims on a weekly basis. Take those all together because what ends up being in the non-farm payrolls number really starts off in the weekly initial and continuing claims. Now, when you look at the non-farm payrolls number, this is one of the most favourite numbers amongst the day trading community because it creates volatility on the day.
However, the big money is not made there. A lot of the time, the first move is the wrong move. In fact, that's a big saying in the market, simply because we've been told for weeks already, pretty much, that economists' estimates are probably wrong and economists are slow to change their estimates. So whenever there's a beat or a miss and you get the first move in non-farm payrolls, pretty much most of the time it's the wrong move because it's already expected. And then the day traders are basically giving the guys who have predicted it liquidity to get out of their positions. So the employment situation report, including the non-farm payrolls and unemployment rate, along with weekly initial and continuing claims, is important because it confirms or denies your views that you held at that time, but you made months before. Why they're also important is because jobs is a politically sensitive issue in the United States and also all over the world. So it can actually predict if there's big problems in the jobs sector, in the jobs numbers. It can predict future government behaviour, and also consumers may actually start to react to very bad or very good jobs data simply because it's in the mainstream media. But if it's kind of here nor there, and it's always meeting expectations, you won't see material changes in government policy or in consumer sentiment and behaviour. Moving on to durable goods. Durable goods are big ticket items. All the spreadsheets are there, and you should download the spreadsheets next to the video and have a look at the numbers in the durable goods spreadsheets, because occasionally you do have to read the numbers by stripping out the big ticket situations such as transport and aerospace and defence, because one order can move the entire number, the composite number of durable goods. So sometimes splitting out these numbers is good, and when you do this on a monthly basis and you go through the numbers and put them in your spreadsheets, you'll see what we mean. This is just something you have to get used to doing. And the final number, industrial production, really when you look at durable goods and industrial production as coincidence indicators, what are they telling us? Well, they're confirming or denying the views that we obtained as professional traders months before in the manufacturing PMI. So when the industrial production number and durable goods number comes out, it's an extension of what we already believe in the PMIs, in the manufacturing PMI as in the ISM. So what you see in the ISM in January, for example, will probably start happening in 6 months to 12 months time, so between June and December in the same year. So see these things for what they are. They're confirmation indicators. Do not, whatever you do, make the mistake as a retail trader, which is the real amateur mistake, by seeing a confirmation indicator and making a trading decision based on it. As in, you see a good non-farm payrolls number, so you go and buy the S&P 500, or you go and buy your favourite stock in the S&P 500. That's just really amateur, and it's just going to get you in trouble because the non-farm payrolls number has been predicted 9 times out of 10. So just see them for what they are. See your confirmation indicators as something that confirms or denies the views that you already have, because at any one point in time you're going to be holding a portfolio that represents your views. And the vast majority of times what you're probably going to see is that the numbers in confirmation indicators, in the coincidence indicators, in the vast majority of cases are actually going to confirm what you already believe. Okay, now we're going to move on from confirmation indicators, and we've covered leading indicators in the US. So now what we've got is an entire repertoire, a suite of indicators that predict US GDP that we can use to take positions in the S&P 500 with. Now what we're going to do is try and get a real perspective of global GDP. So now we're going to take the same principles that we've established in the US leading indicators and move those principles over to Europe and into China. And what you're going to see is indicators, leading indicators in Europe and in China are actually very similar to the United States. They're designed in a very similar way. So that makes our life very easy. So we're going to go over to Europe now, and we're going to look at the Eurozone in its entirety in video number 15. So I'll see you on the other side. See you in the next video.